Hi there, this is Stephen Thomas with another episode of the Housing Debrief sponsored by Mac Financial Services. Just want to say thank you, Alan Mack, for your continued support. And I'm inviting everybody to like and subscribe and smash that like button, subscribe to our channel, get those YouTube algorithms going so that more people can actually see these videos and make some really good adult decisions. So we're going to dive into the 2023 bank run and housing. And, ever since the Federal Reserve came out swinging last August, they started to really change their tune, and they were really going to fight inflation. They weren't going to pivot. They were going to continue to do as much as they possibly could, and this most likely meant pain to consumers and pain to companies. And last year, they took that Fed funds rate and they went the fastest that they've ever gone before. And from the start of the year to the end of the year, we had the biggest change in interest rates ever, as well as the fastest percentage change in the Fed funds rate, which in turn was the interest rates as well that we had ever felt as well. So what they were really looking for was something to break. And they were going to sit back, wait for something to break. They were looking specifically they wanted to see a rise in unemployment. They wanted to see a rise in job openings. They wanted to see retail sales come down a little bit. And what they got was what did break was the banking side of things. And this isn't like what you've seen in the past, and we'll get into that, but SVB, Silvergate, Signature Bank, all have gone under in the last week. SVB was Friday. Silvergate was beginning of last week. Signature was on Sunday. But this is not the financial crisis of 2008. I want everybody to understand this is completely different. And that's because back in prior to the Great Recession on the left-hand side, it was a mixed bag of credit scores of who was actually purchasing the properties, and the loans that they were getting. They were people that just had a fog of mirror to qualify. There were teaser rate adjustable loans. There were subprime loans. There was pick a payment plans. People were starting out on these teaser rates. And there were even dogs and dead people that ended up getting mortgages. It was a real mess. And there was a lot of fraud that was going on. On the right-hand side, this is post Great Recession. You could actually see that the credit scores were quite strong, and they've been quite strong for quite some time as well. So the strong credit performers are the ones that have been winning these multiple offer situations. And as a result, we have a housing stock that is extremely strong. This is a different kind of bank issue, and it had a lot to do with liquidity, because all banks are required to have a certain amount of liquidity. They have them in mortgage-backed securities. They have them in various bonds. They have them in government bonds as well. You can understand, this is just an example. If you have bank liquidity of back in February of last year, a 2-year note was at 1.5%. A 2-year note this month earlier was at 5%. So, and 10 years was at 2% last year. 10-year is at 4% earlier this month. So you can understand that if you had a 2-year note and you're just going to hold it until term 2 years because you're a profitable bank, you want to wait a couple of years to realize some profit on your money, and you hold its maturity. They didn't really hedge for volatility. That could happen. And as a result, the Fed did a lot over the last year. They took the Fed funds rate much higher than people anticipated. They kept changing their tune, and bonds just kept on going up as well. So if they're holding a whole bunch of 1.5% 2-year treasuries, and now today they're worth 5%, you can imagine if there was a whole bunch of people where they had to replenish their money because there's a whole bunch of people that were looking to take their money out of a bank, they can't really sell off their 2-year treasuries at their full amount, because today somebody could get 5% for their 2-year treasuries versus these 1.5%. They were getting like 50% on the dollar, 50 cents on the dollar. They were losing so much that they were sitting on major losses. And you could see that in the bank the bank lines, the ATMs. You saw all the different stories where at SVB there was people that are lining up around the block because they were trying to get their money out of the bank. So we had a modern day bank run. And that modern day bank run was made worse by Twitter when some of these venture capitalists actually got onto Twitter and said, we're taking all of our money out. And as a result, there's a lot more people that caught wind of this, and a lot of people started taking their money out. So it happened almost overnight, seemingly. So the FDIC, the Federal Reserve, and the Department of Treasury got together over the weekend, had emergency meetings, and they came up with what is termed the Bank Term Funding Program. And know that this is not paid by taxpayers. This is actually paid by fees that they have to pay in for the FDIC. And so there is a real program that is in place now. And there's still more banks that are having issues. First Republic is having issues. There's been major cash infusions from various banks that are committing to infuse some capital into First Republic. And as a result, today the stock market was way up. But you have to understand that there are going to be probably more banks that are vulnerable, and there could be other bank casualties as well. So we're gonna have to see how this all develops, but this is developing on an hourly, on a daily basis. Now, expect next week for the Fed to come out not hawkish, but dovish. They're going to change their tune. They might still go up that 0.25% that they talked about. There's a lot of people that say they shouldn't go up at all, that there's even some people that are saying they should cut. But it looks like they're probably going to go up 0.25%, but it's going to sound very dovish. And we're starting to get a shift in where mortgage rates and bond rates and everything are going at this point. And this really does affect the housing side of things. So the United States 10-year Treasury, you could actually see on point, there's two arrows. The arrow at the top shows you where we were at the beginning of last week, where we were above 4%, and then where we are as of, about an hour ago, Pacific Standard Time, 1 o'clock. 10-year Treasuries at 3.573%. So you can see how far we've come down since just last week. So what that's saying is that the Fed is going to have to change their tune. And you can see it in the 10-year Treasury. You can actually see it in the 2-year note as well. But you can see it in mortgage rates. Mortgage rates were at 7% last week, and they dove all the way down towards 6.5% right now. And this is compliments of Mortgage News Daily. So we're seeing that interest rates are coming down, and they're making it right at that level where we have a hard time getting that much further below this. I mean, we've tested it before. It got down towards 6%. Just as we had the 10-year Treasury get down to about 3.4%. So there is some room for it to go, but it's going to get harder for it to go down even more unless we see other trickle-down effects of slowing of the economy. But we'll just have to see, because this is very volatile, constantly moving. Now, how this affects the overall housing market is mortgage credit availability starts to get a little bit tighter. It's already tight, though. You have to understand. It just means that everybody's going to have to batten down the hatches, and people are really going to have to qualify for loans. There's not going to be any Mickey Mouse loans that are out there. But that also brings us to our sponsor. Our sponsor, once again, is Alan Mack from Mack Financial Services, and he's part of the $1 million plus program, Superior Luxury Residential Financing. That is what he focuses on. And he deals with non-conforming loans above $726,200, which is what we actually consider as jumbo products. Network of private and regional banks. He knows the best of the best in these banks. He shops the lowest rate, gets the best rate in town. He formerly was a banker way back in the day, so he has a lot of relationships. He has also high net worth clients that he works with for cash flow analysis and asset depletion. And he has a special 2-1 buy down program. It's a 7-1 arm with 20% down, and it starts in the mid 3s. And he also has a special program, 80% up to $5 million. That's the mid to high 5%. That's where that's at. So, you know what? Call him. He's got loads of experience. Alan Mack with Mack Financial Services is part of the 5-star professional 2022 market leaders. And you can contact Alan Mack and let him get you the lowest rate at Mack Financial Services. 949-929-1091. That's 949-929-1091. Thanks again, Alan, for your continued support. Now, the housing market, yes, There is a lot going on right now. It's hard to even describe what's going on, and to let you know how this is how these rates starting to come down a little bit, how that's gonna play into everything. Once again, buyers are really going to have to qualify. They're going to have to make sure that they're doing minding all their P's and Q's and fully qualifying and listening to their lender and getting everything done. But there's this tug of war going on between buyers and sellers, and this tug of war has been going on for quite some time, where buyers were winning because we had more inventory, but that has changed. That has changed across the United States. That has changed in Southern California. We've actually seen the inventories continue to go down. This is as of today. It went down another 1%. It's kind of flat, but understand that where we're at right now is very low. It brings us to the May 2022 levels. Last year, we were at 13,310, which is 32% lower. But last year was a supply catastrophe. Where we are today is what I refer to as a supply crisis. We do not have enough homes because if you compare where we are today to where we were prior to COVID, there were 80% more homes prior to COVID than where we are today. So there are just not enough homes out there, and the fewer and fewer homes that we have, the more that it lines up in favor of sellers. And as a matter of fact, and I've shown this in prior episodes, but it's very important to point out there aren't a lot of people that are coming on the market, which is adding to the side of the equation of not enough homes. If we have a January and February, we had a lot of people not come on the housing market, and that is what we're seeing. I'm like pointing to the wrong thing, but what we're seeing right over here, that blue solid line is really, really low compared to the prior years. Now, the dotted blue line is based upon January and February. Where do we go from here? It looks like it could continue to go where we're going to be muted for the rest of the year. And it was muted last year. That's the orange line. It looks like it's going to be even more muted this year. And that is because of how high mortgage rates are compared to where everybody currently in homes has mortgage rates today. So that is going to be a real issue to continue to watch. But what's occurring is we're missing a lot of sellers in the market. So it is continuing to mute the supply side of things. And so that's the supply side of the equation. And when we look at the demand side of the equation, demand has been basically flat. This is for two reasons. One, we had interest rates that went all the way up to 7%, but we're starting to see interest rates come down right now. So this should bode well for the demand side of things. But you can't buy what is not for sale. And with the muted number of sellers, what's happening is demand is muted as well. And we have, within the last 2 weeks, within the last 4 weeks, the inventory hasn't changed at all. And it's the lowest March level since tracking began in 2012. So we're really low, and that has to do with very few sellers and a higher mortgage rate. Last year, we were at 16,311. That's 47% more than where we are today. And the 3-year average is actually 49% higher than where we are today. So, that's the muted demand side of things, but match that against the muted supply side of things, and you've got a pretty hot market. As a matter of fact, the expected market time, that's if you place your home on the market when you open up escrow, is at 53 days across Southern California. It's the lowest level since June of 2022. I'm pointing to where it is. We were going to have a hot year in 2020. That's the green line, but then we had COVID. That's why you see that all of a sudden change. But last year we were at 24 days. It was the hottest point ever for Southern California last year at this time. The 3-year average is 64 days. And here's what's super interesting is LA is at 61 days. Orange County is at 41 days. 41 days is extremely hot, and it's almost insane where it's at. Riverside's at 58 days, and San Bernardino's at 64 days. Not quite as hot, but San Diego's at 34 days. San Diego is the hottest market that I'm tracking, and I'm also tracking other areas like the Bay Area, Phoenix, Vegas, Sacramento Valley. And Ventura is at 37 days. Those are extremely hot markets. And as a result, we've actually seen that open houses are back. This is actually an open house from last weekend that an agent shared with me. He said that there were over 400 families that went to this open house. That is a ton of people that are going to open houses because there's just not enough sellers out there. And as a result, when you get that kind of demand, we're getting back this ridiculous notion of what? Multiple offers, where these I think he got an extra $100,000 above the asking price. So that's back. This is an unhealthy side of the marketplace. I'm not for the long lines at open houses with where mortgage rates are today. I'm not for this multiple bid on properties, but that is because interest rates are a little bit too high to encourage sellers to come on. So where are we going from here? To wrap it all up, with the volatility of the banking system, I can see rates are starting to drift down, which will cause more demand, but they need to drift down more before we invite more sellers. So this is starting to really line up in favor of sellers and is starting to get unhealthy again. But we'll continue to watch and observe how everything unfolds from here and continue to bring you the play-by-play. If you want a copy of this, you need to be a subscriber to the Housing Debrief. Go to reportsonhousing.com and subscribe. The most recent one is called Supply Dilemma, and those along the coast, San Diego, Orange County, Los Angeles, will get a new report this coming up week. If you want to be a subscriber, go to reportsonhousing.com, and there's a coupon code for a free month. It's Banks. So please go there and subscribe. And thank you for tuning in. I hope you have another fantastic finish to your week. And just thank you for tuning in. And if you have any questions, put them in the comments. I'll be more than happy to answer anything. But hope you are understanding this a little bit more. But like I said, put anything in the comments. We will do our best to answer everything that's in there and help explain things in further detail. Thank you much. And once again, have a great finish to your week.